As we look at the screens today, Robinhood Markets Inc. is trading at 108.23 USD, showing a decline of 2.12 points or 1.92% during this intraday session. While the red numbers might cause a quick flash of concern for those checking the Robinhood app between meetings, the underlying narrative here is much more complex than a simple daily pullback. Most people see a nearly 2% drop and assume the retail hype is cooling off, but the reality is that institutional activity suggests a massive repositioning. While the average user might be worried about their Robinhood investments or whether their Robinhood fractional shares are losing value this afternoon, big-ticket asset managers have been quietly increasing their stakes. This creates a fascinating tension between what the headlines say and what the order flow reveals. Most investors are looking at Robinhood as a barometer for retail sentiment, yet the company has fundamentally shifted toward becoming a serious contender in the individual brokerage space, challenging giants like Fidelity and Charles Schwab. The common belief right now is that Robinhood is strictly a high beta play on market volatility and crypto cycles. If the market is up, people think Robinhood stock will soar. If the market is down, they expect it to crash. But if we look closer at the recent stock movement, we see a pattern of resilience that defies that simple logic. Throughout the last few weeks, the volume has remained consistently high even on down days, which often signals that shares are moving from weak hands to long-term holders. We are seeing a significant amount of capital flowing into the Robinhood trading platform from users who previously only used Schwab Intelligent Portfolios or had a small interactive broker's account. This isn't just about the 24-hour market anymore. It is about the fact that Robinhood has successfully integrated itself into the daily financial habits of a much wealthier demographic. The expectation was that Robinhood would always be the starter app, but the reality is that their average revenue per user is climbing because they are capturing more of the wealth that used to sit in traditional Fidelity brokerage accounts. When we look at the daily swings we've seen this month, it is clear that macroeconomic pressures are weighing on the entire financial sector. The talk of interest rate adjustments has put a spotlight on net interest income, which has been a huge driver for Robinhood recently. Unlike the days when they relied almost entirely on payment for order flow, now they earn a massive amount from the cash balances sitting in the Robinhood cash management accounts. This is where the tension lies. Investors expect the stock to struggle as rates potentially stabilize, but they are ignoring the massive growth in the gold subscription model. Gold has become a legitimate competitor to Fidelity Wealth Management for the self-directed investor who wants high yields and low costs. People are moving their portfolios over to take advantage of the 3% IRA match, which is a move that traditional firms like Fidelity or Interactive Brokers have had to respond to with their own aggressive promotions. Recent institutional activity shows that hedge funds are increasingly using HOOD as a way to play the broader adoption of online investing across different asset classes. For example, the expansion into prediction markets through the Kalshi partnership has created a new type of engagement that doesn't exist on most other investing sites. This creates stickiness. Once a user starts using the Robinhood app for everything from buying Nvidia stock to betting on the outcome of a central bank meeting, they are much less likely to leave for a Fidelity trading platform or a SoFi active investing account. This is a strategic moat that the market is only just beginning to price in, despite the 1.92% drop we are seeing at this moment. Sector momentum is also a huge part of the story. The fintech space has been white hot, but there is a clear divide between companies that are just apps and companies that are becoming banks. Robinhood is firmly in the latter camp now. They're competing for the same dollars that go into Fidelity ETFs and Fidelity mutual funds. They've even introduced their own version of an intelligent portfolio to compete with the likes of the Schwab Intelligent Portfolios. If you look at the trading volumes for big names like Tesla stock or Apple stock on the Robinhood platform compared to Interactive Brokers trading, you'll see that Robinhood is capturing a larger share of the retail flow than ever before. This is not just about small accounts. The whales are moving in. We are seeing more accounts with 6- and 7-figure balances opting for the Robinhood crypto and equity tools because the user experience is simply superior to what the legacy brokers offer. For those who are new to the company's story, it's worth remembering that the business model has undergone a total transformation since the early days of the pandemic. While they still offer commission-free trading, the revenue mix is now highly diversified. They have their hands in everything from retirement accounts via Fidelity IRA competitors to advanced derivatives. Their recent acquisition of Buana Capital in Indonesia shows a serious commitment to global expansion, moving into markets where online investment is just starting to take off. This isn't just a US-based story anymore. They are taking the fight to international platforms, showing that the Robinhood trading experience can be exported to fast-growing economies. This is the kind of aggressive growth that justifies the current valuation, even if the short-term chart looks a bit choppy today. Looking at the older reports, we can see how the company has consistently beat earnings expectations over the last year. Analysts keep underestimating how much capital users are willing to move into the ecosystem when the incentives are right. The 1% boost on deposits and the competitive rates on margin have made it the go-to for anyone who wants to do self-investing without the clunky interface of an old-school bank. When you compare the Robinhood fees, or lack thereof, to the Interactive Brokers fees, the choice becomes very clear for the modern active trader. This is why the stock was added to the S&P 500, a move that forced index funds to buy millions of shares, providing a new floor for the stock price that didn't exist 2 years ago. Comment below how many shares of Robinhood you currently hold, or if you've recently moved your assets from a traditional broker like Fidelity or Schwab. It's always interesting to see the shift in where people are keeping their capital. As we look toward the future outlook, there are several catalysts on the horizon that could break this current downward trend. The planned launch of 100-ounce silver futures and more complex derivatives will likely attract the high-frequency traders who currently live on the Interactive Brokers platform. Additionally, the legislative environment for crypto is becoming much more clear. As regulations provide a more stable framework, the Robinhood crypto segment is poised to capture a huge amount of the volume that currently goes to dedicated exchanges. The expectation is that regulatory hurdles will slow them down, but the reality is that Robinhood has built one of the most compliant and robust systems in the industry, making them the safe choice for retail crypto exposure. There are risks, of course. A significant downturn in the price of Bitcoin or a sudden shift in retail participation could hurt transaction-based revenue. However, the growth of the recurring revenue from Gold members provides a buffer that the company didn't have during the last market cycle. They are also facing stiff competition from SoFi, particularly in the robo-advisor space. The SoFi robo-advisor and SoFi ETFs are popular with the same demographic, so Robinhood has to keep innovating to stay ahead. But when you look at the sheer scale of the Robinhood mobile app's reach, it's hard to bet against them. They have the brand recognition and the user-centric design that other investing sites struggle to replicate. In summary, while the live price of $108.23 USD and the 1.92% dip today might seem discouraging at a glance, it represents a classic gap between market expectation and fundamental reality. The market is treating this like a volatile retail stock, while the internal metrics show a company that is successfully maturing into a diversified financial titan. They are no longer just an app for buying a few shares of Apple stock or Tesla stock. They are a comprehensive wealth management solution. From Robinhood Investments to the Robinhood trading platform and beyond, they are building an ecosystem that is increasingly difficult for users to leave. Whether it's the 3% IRA match that rivals Fidelity Brokerage or the advanced tools that challenge the Interactive Brokers account, Robinhood is playing the long game. The tension we see today is just noise in the context of a much larger shift in how the world handles capital and investment. The authority of their position in the market is being solidified with every new product launch and every institutional buy order, regardless of today's intraday movement.